And so I challenge every single bank. You got to change the dynamic and really get something done in that boardroom that brings up a little controversy, right? I tease ALCOs and now I'm starting to tease boards. One observation I make at both: stop treating them like dentist appointments where everybody good. Nobody's hurt. We're all right. I'll see you in 3 months. Let's get out of here. You can't do that anymore. When rates are going to move 18 different ways between now and the next meeting.
Hello, everyone. Brian Love, head of Banking and Fintech from Travillian. Nice to see everyone again on the Travillian Next podcast. We have a very familiar face. I think Scott may have been on this podcast more than any person in the industry at this point. So I wanted to welcome with me Scott Hildenbrand, who is the head of depositories at Piper Sandler. Did I get that right, Scott?
It's close enough. Yeah, Brian, that's close enough. We're good.
I think each webinar you've had a different title, but who's counting? And I also invited my colleague, Mike Perito, head of bank strategy, to be with us because he can talk this talk almost as good as you, Scott. How are you, Mike?
Good. Not quite, though, but we'll stay dangerous.
Well, and obviously, Scott, every conversation we've had over the years has been about balance sheet strategy. I mean, that's your bailiwick. And so I figure what a time to kind of bring you on. A lot's happened over the last couple of years. We're right in the middle part of 2025, and you visit boardrooms and strategic retreats all the time. So we want to hear what you're hearing out on the street. So as we get started here, I don't know if you had any introductory remarks about kind of the state of the union right now and what banks should be or are thinking about right now.
Yeah, no. Thanks, Brian, and Mike. Great to see you as well. And Brian, thanks as always for being brave enough to have me on again. Always enjoy my time with you all. Listen, I'll give you a quick overview of sort of what we're seeing, what we're doing, and where we're spending our time. Right? I mean, you think about it; it's really been an interesting, let's call it 18 months. Even if you call it back to 2 years, I remember November of 23, Brian. We were down at our equity investor conference. So this is November of 23. We're post SVB, but we're still feeling it, right? And that conference, we bring all our investors to meet all of our publicly traded banks. It's a lot of fun. You learn a lot. It was like going to a funeral. It was brutal. It was no fun. No one was having any fun. We had no yield curve, the liquidity squeeze, the bank failures, bank valuation stunk. It was just not a lot of fun. You fast forward to 1 year later, November of 24, right after the election, same conference. 1 year later, it was like going to a concert, Brian. I mean, the anticipation of regulatory reform, the anticipation of rate cuts and a yield curve that's actually positively sloped. The M&A wave, given some regulatory reforms, was supposed to be on fire. We knew the back half of this year of 25 begins the debt refinancing for all the sub-debt that was issued in 20 and 21. And so there was a lot of anticipation. And we've had some ebbs and flows, right? We've had the tariff day, which was quite interesting. So that was obviously a stop. We've had some geopolitical stuff overseas that has caused a lot of volatility. So we've seen some M&A, but nowhere near, if I was guessing, what I thought we would have seen. We haven't quite seen the regulatory reform in the sense of exams, liquidity testing, interest rate risk. That's still on top of mind, and that's not gotten any easier as I talk to the folks all throughout the country. The one area we've seen some regulatory excitement, am I allowed to use regulatory and excitement in the same sentence? But I will. I'm never afraid. But the excitement on the regulatory front has been the short time periods around M&A announcements and closing. Those have shrunk. We've gone to the days of a long time, which really put a lot of pressure on the bank to select the right bank and make sure the talent's locked up and you don't want to lose anything through that deal. And the longer those deals would go, the more risk you had. So it's great to see that. It's also great to see some of the banks like Seacoast who are allowed to now announce multiple deals at the same time or very similar time frame. That's another positive from from a regulatory perspective. I'd say from a balance sheet management, pure asset liability perspective, we're still kind of stuck. There's a lot of folks who are still weighing the options of, do I reacquire myself and acknowledge the fact that my asset base has some, if not a lot, of assets that were either purchased or originated during COVID at all-time lows and rates. And we've got liabilities that flipped on us right around SVB when we were seeing the major rate hikes to attack inflation. So there are upside down portions of almost every bank in this country. Whether it's through an M&A transaction or just yourself, reacquiring yourself, that is still on top of mind as I travel boardroom to boardroom. Scott, should we restructure? Are we going to restructure? What is the street going to think? What are my examiners going to think? How do I get my board comfortable? So there's a lot there from an education and execution perspective. And so it's all connected. It's whether it's M&A, capital markets, balance sheet management, they're all connected, of course, with regulatory world and, of course, with where the investors are valuing companies, what they're thinking about. Hopefully bank stocks continuing to improve a little bit here. And it's all connected, Brian, as I like to say. You can't have one conversation without the other, which is why, honestly, I love my job. So a lot of fun, and we can go in any direction from here.
Yeah, well, let me bring Mike in.
Yeah.
Mike, why don't you go ahead and ask your question?
That's a good segue, Scott, because one of my questions for you was, we had you on the stage at our next forum about 10 months ago, in September of 24. And a lot of the conversation was about hedging. Yep. And we had our friends from Derivative Path on the stage as well, talking about how small cap banks are typically under-hedged, right, and not utilizing that enough. There's a lot of discussion about capital, securities books, restructuring. So it sounds like a lot of that's pretty consistent 10 months later. Is that fair? Is there anything else new that's starting to pop up as people are looking to the back half of this year in 26?
And Scott, before you respond, let me just also remind the audience that Scott will also be at this year's next forum in Philadelphia, Travillian and Alden's next forum. And Piper is a sponsor, and we're very proud of that. Thank you so much. If anyone out there is interested in joining, please reach out to me. But go ahead, Scott. Please answer the question. Sorry to interrupt.
No. And again, I look forward to being there. Mike, the way I would say it is I was actually right for once, which doesn't happen very often. But the same conversations I was having late last year, pretty similar to where we are this year. And that was kind of predictable. And what I mean by that is, from a hedging perspective, I'll pick one nuance here. From a hedging perspective, about 50% of our hedging business right now is hedging against higher rates, and 50% is hedging against lower rates. We got folks all over the map who've got all kinds of different exposures. I pay attention a lot to that because typically we see 80% going one way and 20% going the other. When you see 50-50, Mike, it means we got volatility everywhere, as we all know, right? From all the major changes here in going around the country. So hedging is still top of mind. But again, it's all connected to the debt capital market space, right? I mean, and one thing that's really interesting to me is we've got a ton of deals that were issued in the back half of 20 and all through 2021, right? So you think about hedging, obviously thinking about the interest rate risk position of the company, and you can go higher or lower. Now you also have capital markets decisions. Every single bank that issued in 20 or 21 has to make a decision. And decisions are statements, right? You either decide to refi, you decide to let it float, or you decide to call the debt. All three of those, if I'm an investor, if I'm a board member, if I'm a regulator, they all have consequences. So we're having a lot of discussions around, can I take the debt? Do I want the debt? How am I going to grow? What type of interest rate risk do I need to take to grow? Can I handle that and hedge that? So that's all been obviously part of what we've been talking and dealing with as well. So hedging, debt capital markets. And then the other point we talked a lot about on stage that day too was restructuring of securities portfolios. And what I'll say about that is right after September, we saw a ton of them done. Right after we got off stage, a ton of those. And I remember mentioning that to you all, that there's a pipeline of these, and we saw a ton of those. It's been a rain delay, Mike, the last 6 months on restructurings. And I don't want to call it seasonal, but it kind of is. As you get closer to the back end of the year and we haven't really seen rates fix anything, I think another year of sitting there looking at, as I mentioned, underwater assets funded with 4% liabilities, at some point that gets old. And I think you're going to see now more and more boards revisiting again as you get closer to the end of the year. hey, is it time, Scott, that we need to take a loss here, restructure this? How do we end up doing it? Do I have to combine it with a sale leaseback to manage the loss? There's so many different nuances to the restructuring, Mike. But exactly what we talked about on that stage that day is kind of where we're spending our time. All of those topics are certainly in play.
Yeah, and in the current environment too, like loan growth slower, NIMs have been slower to expand. So, I mean, no one will tell you this, but everyone's playing for better comps in 26, right? So, like, if you're going to do a restructuring, end of 25 probably makes some sense. Get that NIM higher next year, hopefully get the earnings up. So that makes a lot of sense to me. Do you think the goalposts on ALCO planning have changed at all? Like, are banks trying to be more neutral actively than what you experienced or what your historical experience tells you from 3 to 5 years ago? Or would you not agree with that?
No, I would agree. Thankfully, I think we've pivoted from a world of now. I give banks the benefit of the doubt because when I started 20 years ago, rates didn't move that much. Certainly not intraday, not weekly, not monthly. Today's day and age, you can look at it two ways. You can look at it and run and hide, or you can jump with a cannonball right into all the opportunities you have. My mantra has always been, Mike, every 20 to 25 basis point movements across different shapes of the yield curve, my bank should already know what we're going to do from an ALCO perspective, have authority from management, and execute. So those folks that are doing that, it's been a field day in a really positive manner because you can address serious issues based on one tweet, one news of over a weekend, something can happen and bang, you see an overreaction one way or another. Those are the times to take care of some situations internally on the balance sheet. So it's been a lot of fun from that perspective, Mike. And I will tell you too, the one thing that it probably isn't talked about enough that I think a lot about is there's serious refinance risk on the asset side of every balance sheet. Right? You think of everyone that sat there for 5 years and waited for those assets to reset and reprice, typically in that 5-year time frame. Well, we're getting closer and closer, and you see a drop in interest rates, and all of a sudden that margin expansion, it's not being fixed by growth, to your point, because it's not been as much. So now I need my organic balance sheet to move. Deposit costs have kind of flattened out, so I'm really relying on asset yields going higher. So we're doing a lot of hedging of refinance risk 6, 12, 18 months from now on the asset side, very similar to the conversations we're having on the liability side or the capital stack with the debt capital markets.
Yeah, that makes a lot of sense.
Good.
So, Scott, I wanted to take us, and we've talked about this on many other conversations. You have a good portal into the boardroom and also kind of an understanding of the talent trends.
Yeah.
And the CFO seat, I'm thinking of the two most recent CFO searches we did. The chosen candidate was completely different than the previous CFO. Way more strategic, different personality. And we've done so many of these CFO searches. Some of them are retirements and we replace people with the same beats. But these last two it was like a sea change. They want more out of that seat. So I just wanted to understand, like, do you think banks currently possess that talent to stay ahead of the needs of a bank in 2026 and beyond?
Right.
Are they maybe more reliant on vendors? And then how do you develop people as well? It's kind of a multi-pronged question there.
But it's a great one. And it's one that I think our industry's facing right now. And it's why I'm big fans of what you all do. I mean, honestly. And here's the problem, right? The talent is here. The problem is the experience of what we're dealing with is so much different, right? To think about what we've gone through in just the last 5 years, rate movements, balance sheet changes, volatility is 10x what I lived my first 15 years of my career. So the new CFO role is completely different than the old one. The older CFO role had to have different hats, not less, just different hats than what the new CFO hats, in my opinion, have to wear, right? You think about some of the things that that being a CFO for the last 30, 40 years, one thing he didn't deal with as much was true interest rate risk. We talked a lot about it, but we didn't see major moves around interest rate risk. I would say the one thing I worry about most with CFOs getting to the retirement age is they went through 08, 09 and have a lot of experience understanding and dealing with credit. Right, that's one area where, Brian, I worry about as we get strategic in the CFO suite more strategic on transactions and ideas and balance sheet management, which I think is where we have to go. I still hope we're taking our notes and we're going backwards a little bit and making sure we're refreshing sort of that the liquidity credit crunch. We've seen liquidity crunch, but that SVB had nothing to do with credit. That was a much different conversation. And so, yes, I think the talent is there. I worry more, and you said the right word, Brian, development. The development of what a new CFO, and I always say this internally at my team, when we think about hiring, I'm always like, okay, can we stop thinking about how we have hired and let's pretend we're starting this team today? Because what I needed from folks 15 years ago, 10 years ago, 5 years ago is much different than what I need from folks going forward. And when you take that approach, whether it's a bank or my role or wherever, I think you end up looking at it a little bit differently. So I'm challenging us right now as we go through some stuff to make sure we're thinking about, if we were going to start a bank right now, what type of chief financial officer do I need going forward, given the fact that all of the banks we talk to, for the most part, live and die by their spread. And I will tell you right now, same bank, and I've said this many times, today, with same management, same yield curve, same products, everything. And 20 years ago kicks its butt on a spread perspective. It's not even close. The business has been commoditized. So it means opportunity for the forward-thinking, athletic, nimble chief financial officer who, to Mike's point earlier, is sort of already prepared, has authority to get transactions done strategically and not wait for a rate movement to write a memo to talk to the board about hopefully doing a transaction that fixes the last move, right? We're moving that mentality, and that's exciting, I think, for the industry. It's also challenging, Brian, to your point.
Yeah. I love that word challenge, though. It's something that comes up in our work a lot. Like when we're talking with boards about whether it's succession or strategic planning, It's like, are you challenging the inputs you're getting, or are you just taking them as gospel? Like we see something sometimes, and it's like, if something was down 10% last year and the budget says it's up 10% this year, like, are you questioning that? Are you are you pushing back on why all of a sudden something that has been down by so much can reverse and be up by so much, right? I think that just needs to happen more at every level of all these banks. And I think some of is reactionary, but still appropriate. It's just a different, faster moving world than what it was 10, 15 years ago when you maybe had 6 months to respond to a movement in rates. Now you have not even 6 days. I mean, it's really different.
And I think you bring up a really good point when you think about and this is something that I am concerned about, and it's all connected to what Brian's question is around talent. The dynamic needs to change in a lot of institutions between management and the board. And one of the things I think, and I'll just say it, and no bank will nod their head yes, but I think when they're alone, they're like, oh, he might be right. A lot of folks typically, what I've noticed is it's sort of this double-edged sword of, well, I'm not going to go down this path in the boardroom because it's going to open up a can of worms of X, Y, and Z. So we're not going to talk about it. And the board is going to then not know to challenge that assumption because they haven't been fully educated on it. And back 10, 15, 20 years ago, I think that was okay. Our boards were there for a different purpose. Our board members now have different roles and responsibilities at these institutions 100%. than they did 10, 15, 20 years ago. And so I challenge every single bank. You got to change the dynamic and really get something done in that boardroom that brings up a little controversy, right? I tease ALCOs and now I'm starting to tease boards. One observation I make at both: stop treating them like dentist appointments where everybody good. Nobody's hurt. We're all right. I'll see you in 3 months. Let's get out of here. You can't do that anymore. When rates are going to move 18 different ways between now and the next meeting, we've got to get to some decisions made. And it starts with education. The fact that we are not doing more of the following: playing Monday morning quarterback, going back through 2022 and 2023, sitting with the boards and saying, these are the 5 things. This is a great CFO will do this. This is the 5 things I could have done. I didn't do. These are the triggers that caused it. This is how we could have seen it. And also, Mr. and Mrs. Board Member, this is why you would have said no. And having that open conversation, right, is really, really important. I always say good CFOs, they hear yes all the time. Great ones hear no. And if you're not hearing no in the boardroom enough, to your point, Mike, then you're not getting challenged. You're not having those discussions. With all due respect to board members, really talented folks, smart, usually it's something other than banking. So of course they should say no the first 4 times I come to them with a hedging idea, because they think of everything as asset generation, not spread management. That's a really important concept as you think about being a chief financial officer in today's day and age and pushing the envelope on strategy and development.
Yeah. It made me think. We were in a boardroom, Mike and I, not long ago, and one of the board members was talking about the board notes. It was just a lot of data.
Uh-huh.
And it seemed like it just needed to be story told a little bit better to the board. And I think some CFOs are guilty of that. Sometimes they just kind of kill you with data, but they need to be able to kind of, like you were saying, examine it and talk about it in layman's terms. A lot of the board members are not finance types. So
and it's intimidating, Brian, right? Yeah. And we've all been on both sides of it. It's intimidating to look and get a package of 712 pages of numbers. And yeah. I'm like, okay, I know I'm supposed to read some of this. I got to have some information on what I understand here. But honestly, you hit the nail on the head. It's not the data. It's how we communicate the data. It's not the strategy that is why it dies. It's the way we present it and communicate it. There is the biggest, the disconnect. It's not, I always say this, it's not the how. We all know how to fix balance sheet management issues. We're not splitting atoms. It's not that difficult. The problem becomes when and communicating how to do it. And those are 2 big problems I see as I travel around the country.
I'm going to let Mike ask kind of a final question. But before I do that, real quick question for you, because I'm just curious. AI. Everyone's talking about AI. I'm kind of interested in how Piper is adopting it, how your division is adopting it, and then if you have any thoughts at all about it. I know you can't escape talking about it these days. Yep. I was just kind of curious what Scott's experience with it is.
Yeah, well, some people will chuckle at this. I grew up in the Philadelphia area, so I immediately think AI. I think of Allen Iverson. So just to be I played basketball in college. Just be very blunt, so you can imagine how much knowledge I have now.
Practice? We talking about practice?
Actually, we're talking about artificial intelligence.
Artificial intelligence.
Yeah.
Thank you.
Darn, I was about to go into my hoops days. No. So, but as I really, truly, honestly think about AI, I think a lot about at our stage in at our firm. I think the first and foremost place where we're trying and currently trying to think through it is if you imagine all the data we collect, Brian, right? It's from our customers, our clients. I get a lot of, hey, Scott, take a look at this and tell us what we should do. That's kind of what happens, right? And I'm paraphrasing, but getting that data captured, analyzed, and put into a format, to your point, because I lose interest after 2 slides. If you've ever seen me public speak, I don't have more than 3 for a reason. But if that, for me and for where we're going, is absolute number one. I don't want to call it back office, but analytical and data collection and analyzing is without a doubt on my mind number one for us. And I think the same for banks, right? There's a lot they can do there so that I don't have to hire 27 junior analysts to punch numbers. I want to hire 27 junior analysts to talk through ideas and present strategies and get to your point, to what the issue is. And here are the 3 ways we can potentially solve it. So that's the way I kind of think about it.
The CAIO is going to be the next big C-suite, I guess.
Yeah, that's a good point.
Yeah. And we're all going to, at that point, realize very quickly that we all picked the wrong profession when you see the numbers.
I had that realization 10 years ago, I think.
Yeah.
But nonetheless, the numbers always do tell a story, right? And that's what you mentioned. You love your job. That's what I love about my job. The numbers do tell a story, and it's not the same story. Opinions, historical experiences can all impact it. One person could think their numbers are great. I could look at it and think they're awful, right? It just depends on your perspective. But maybe to wrap us up here, Scott, and this has been great. The bank stocks have actually been running a little bit more recently. We've seen some M&A, not necessarily normalized, I would say, but some. And as you mentioned, like we were on the West Coast, Brian, and I recently had a lot of talk about Glacier doing 2 deals. Like banks are clearly starting to cash in on this idea, like, hey, we can get these things announced and we can get them closed. You mentioned the debt capital market side, the debt maturity wall that's coming up, the ECM stuff has slowed down. But like, what's Piper Sandler's outlook for the next 6 months? What's the crystal ball? I'm not going to make you go out further than that because who knows. But how do you kind of what's the in-house view on how the next couple quarters could go for the bank group?
Yeah, and thanks for the question because I get it a lot, and I'm sometimes a pessimist, but right now I'm feeling really good about almost everything you just mentioned. Number one, it all starts and stops with bank valuations. We can talk about all the other things around M&A, and there are other hurdles, but at the end of the day, Mike, is really well where you're trading and where your stock is ultimately going to be a big driver of the volume of M&A increasing. So I think you're going to continue to see that. I can tell you without a doubt in my mind that our pipeline is bigger year over year, without a doubt. It's not even close. So there's a lot of discussions. Bank valuations still aren't quite there yet. And the other problem, and it's all connected, is then the interest rate environment. You're still, when you're looking at a target and you're buying that balance sheet and you're putting it onto your balance sheet through purchase accounting, there's still some negative equity there. So it makes the goodwill adjustment too big, i.e. the valuation. All of that is connected. So we're working through that. A couple more rate cuts will really solve the day there in terms of that. But you're right. Valuations are getting a little better. So I would tell you M&A over the next 6 months will beat the last 6 months, which beat the prior 6 months. We're slowly. We used to talk about major waves. I think these are smaller little steps that you're going to see on the M&A front. The capital markets, you hit it really well, Mike, on the debt side. We know where that's coming. That pipeline is booming now. That is all ready to come. Question I have, though, is are we optimizing our capital stack between common, debt, and the preferred market? The preferreds that have been done blow my mind, right, in terms of the levels that got done for tier 1 capital versus the sub-debt tier 2. Not to go against tier 2 capital. It'll play a role. But if you haven't really looked at your cost of capital and optimizing that stack, I think we're going to see that over the next 6 months. So I expect to see a little bit more volume there. And then I really think, and we talked about this too, you're going to see a lot of balance sheet restructurings here in the back half of this year, mostly in the fourth quarter, as people say, what, I still have an underwater balance sheet. I'm not going to be a really good acquirer until I take care of my own house. You don't put an addition on until you clean out the rest of your house and get it where you need. So I think you're going to see a lot of that blocking and tackling as well, Mike. And then I think we're going to be off to the races into 2026. So I feel good about first half of 25. I feel really good about the back half of 25 and probably feel a little bit better in 26, which is scary because I'm usually a pessimist. But I'm feeling pretty good at how long we've been in this sort of, I'll call it fight of interest rates and volatility and
5
geopolitical.
years.
Yeah, it's been a battle, Mike, right? It has.
5 years.
It really has.
Another year, another crisis.
Exactly right. You're spot on. So we're feeling good. We're feeling really good about where we are. So I'm really excited about that.
And it's good to hear that just because too, like, not to get necessarily political, but a year from now, or not even, probably sooner than that, midterm discussions start to happen. And right now, regardless of your view of politics, it is clearly a better bank regulatory environment.
Correct.
But the first 9 months or so of this environment, we really haven't cashed in on it a ton. It seemed like we were gonna, and then the air came out of that balloon pretty quickly. Now it seems like maybe we're heading in that direction. So I'm hopeful. I actually tend to be bearish too, and I'm actually somewhat optimistic.
I think the one thing that you said that is important on the M&A front too is that there's a lot more sellers today than buyers. That's not always the case. I think you said it. These last 5 years have been an absolute grind. And so I think it'll be interesting to see where that M&A plays out. But that regulatory component, the administration component, will be a driver in the next 24 months of, hey, we should go get some of these deals announced. Once Capital One and Discover got their deal closed, to me, 2 community banks wanting to merge, we're good to go. Let's go. So that to me was very telling and really interesting to see.
Yeah, well, and by the way, the Columbia Pacific Premier deal was announced in April, and there's a pretty good shot that thing closes pretty quickly. So
yes, it is,
and that could be that's a 4-month, 5-month turnaround potentially. So,
and that deal was negotiated and worked on during in April, during the tariffs and all of that, with all that volatility. So really impressive fortitude on those two companies.
Yeah. I wonder if you're as bullish about the Phillies over the next couple days or a couple months.
No, because I grew up in
Another
Philadelphia. So
podcast.
no. Yeah.
Yeah. Well, thanks so much, as always, Scott, for joining us again. Always great insights about the industry, about what you're hearing. Again, I'll reiterate, Scott will be at our next forum, October 8th and 9th, at the Union League in your old haunts in Philadelphia, right on Broad Street. Can't wait to have you up there, and it's going to be a wonderful event. If anyone is interested in that, they can go to our website to learn more, or thenextforum.com. And reach out to me, Brian Love, head of Banking and Fintech, to learn more. It's invite only. And also, Mike, fantastic spending time with you today as well.
Yeah, the Broad Street bonds.
That's
what
right.
we call Scott. Yeah.
There we go.
Thanks for joining us, Scott. Always great catching up with you.
Yeah, Mike, thank you. Brian, thank you as well. I truly enjoy it, and look forward to seeing you down in Philly.
Sounds good. Take care.
Take care.